part E. First, you need to determine which financing option will be most cost-effective for Bulletin, and then you need to discuss other considerations that should be taken into account when making the financing decision. All right, so let's start with part 1. Determine which financing option will be the most cost-effective for Bulletin. Now guys, when performing this calculation, you have a choice. You can either calculate the net present cost or you can calculate the internal rate of return. Now, in order to calculate the net present cost, you need the after-tax cost of debt because we use the after-tax cost of debt as the discount rate when calculating the net present cost. On the other hand, if you calculate the internal rate of return, you don't need a discount rate because we are just going to input all of the cash flows into our financial calculator and solve for the internal rate of return without inputting any discount rate. So you don't need the after-tax cost of debt in order to calculate the internal rate of return. It's also important to note that the internal rate of return is the preferred method to use for the financing decision. Now, if we go back to the information provided in the scenario, for both options, for option 1 and for option 2, you haven't been given the after-tax cost of debt. Now, the after-tax cost of debt, let's just make this a bit clearer over here. This is actually just the market-related rate. Or the rate on similar loans, or the rate on similar preference shares. It's the market-related rate. Now, we haven't been given that information in the scenario. So in this question, you can't calculate the net present cost because you don't have the after-tax cost of debt. We don't have that discount rate. So we are forced to calculate the internal rate of return. So for the loan and for the non-redeemable preference shares, we are going to calculate the internal rate of return. And the option with the lowest internal rate of return is going to be the most cost-effective option. So once we've performed that calculation, we'll then conclude on which option is the most cost-effective. So let's start with the loan. All right, you know when you are performing this calculation for a loan, you need to break your calculation down into 2 steps. In step 1, we are going to calculate our cash flows. Because you can't calculate the internal rate of return if you don't know what your cash flows are. So first we have to calculate the cash flows. Once we have the cash flows, in step 2, we will then calculate the internal rate of return. Then remember guys, in step 1, when you are calculating your cash flows, you should always ignore tax and transaction costs. All right, so what are our cash flows? They are going to obtain a loan of 5 million rand from their commercial bank. So the 5 million rand is going to be the present value. When they enter into the loan agreement, they will receive 5 million rand from their bank. So that will be an inflow of 5 million rand. They then have 2% transaction costs, but in step 1, you should ignore transaction costs, so leave that for now. The interest rate on the loan is 1% above the prime lending rate. This is your coupon rate, which is used to calculate the interest cash flow. So that's what we are doing in step 1. In step 1, we are trying to calculate our cash flows. So if this is the coupon rate that we use to calculate the interest cash flow, this is going to be I in our calculation. And the prime lending rate is 8%. So I is going to be 9%. Interest and capital is repayable in 4 equal annual installments. So N is going to equal 4. And they have a final bullet payment of R1 million at the end of 4 years. So that's going to be an outflow at the end of 4 years, which is the future value. And we are going to solve for the payment, which will give us the annual interest and capital installments. So the present value is an inflow of 5 million rand. I is always the coupon rate because we are trying to calculate our cash flows over here. And interest on the loan is 1% above the prime lending rate, which you've been told is 8%. N is 4. The future value is negative 1 million rand. And you are going to solve for the annual payment, which includes an interest and capital component. So that deals with step 1. We've calculated all of the cash flows. Keep this information in your financial calculator because you are going to use it again. So don't clear your calculator. Let's move on to step 2, where we are now going to calculate the internal rate of return. So now all we do is we know what our cash flows are. In step 1, we calculated all of those cash flows. So we are going to include all of those cash flows on our table. And in addition to that, in step 1, we ignored tax and transaction costs. Now we are going to take into account tax and transaction costs. Then when we have all of the cash flows, including tax and transaction costs, we'll input all of those cash flows into our financial calculator and calculate the internal rate of return. All right, so we are dealing with a 4-year loan, so you need a column for each of those years, and you always need a column for the beginning of year 1, or in other words, column 0. So let's input all of the cash flows onto this table. First, when they enter into the loan, they're going to have an inflow of 5 million rand. Then we have transaction costs. 2% transaction costs will be payable immediately, so at the beginning of year 1, also in column 0. Next, you need to consider the tax consequences on those transaction costs because the company will get a tax deduction for the transaction costs. Now, just be careful. You can't include the amount in column 0 because the company does not do their tax return at the beginning of the year. Remember, they'll only do their tax return at the end of the year. So they'll only get the benefit of this tax deduction at the end of the year when they prepare their tax return. So the tax saving should be included in column 1, the end of year 1. And it must be included as an inflow. The company will get a tax deduction for transaction costs. So when they are calculating taxable income, they will deduct transaction costs. So this is a tax saving. Then let's include the other cash flows. So we've included the 5 million rand, which they'll receive up front. Then at the end of the 4-year period, they have a balloon payment of 1 million rand. And annually, they have an installment of 1,324,675. Then the only cash flow that we have not yet considered is tax. Right, and we have already considered tax on the transaction cost, so we don't have to worry about the tax implications over there. Right now, what we are trying to determine is the tax consequences on the interest. This annual payment over here includes both interest and capital. The capital portion is not deductible for tax purposes, so we don't need to worry about that. However, the interest portion is deductible for tax purposes. So what we need to do is we need to determine what portion of this installment is interest and what portion is capital. Because the interest portion, we are going to have a tax saving at 28%. Now, that's why I told you to keep all of this information over here in your financial calculator, because we are going to use the amortization function in our financial calculator in order to determine the split over here between interest and capital. So this is a separate calculation. And you must show your calculator inputs. So using the amortization function on your financial calculator, pull out the interest in period 1. It should be 450,000 Rand. And do the same thing for period 2, 3, and 4. Now, as an alternative, instead of using your financial calculator, you can draw up the amortization table. So you will see in the suggested solution, I have included the amortization table for you, if that's what you prefer. However, guys, that does take a lot longer, and this is always for very few marks. You're going to get about half a mark for each of these things over here. So I definitely recommend rather using your financial calculator. So what this gives us is, we said this total installment over here is made up of interest and capital. We've now pulled out the interest portion. So we know what the interest portion is for year 1, 2, 3, and 4. Now, the interest is going to be tax deductible. So once again, when Bulletin prepares their tax return at the end of the year, they are going to get a tax deduction for this interest. So we are going to have a tax saving over here. But obviously, the tax saving is going to be at 28%. So we just need to multiply all of these by 28%, calculate what that tax saving is, and then include it in our calculation above. we can then calculate the total cash flows. You are then going to input all of those cash flows into your financial calculator. So show your calculator inputs. We will input all of these as cash flows. And you are going to solve for the internal rate of return. And that's going to give us an answer of 7.1%. Then just one other thing before we move on. We are calculating the internal rate of return. So because we are calculating the internal rate of return, we include this initial inflow of 5 million rand. However, if we were calculating the net present cost, so over here, the net present cost instead of the internal rate of return, then you would not include that initial inflow of 5 million rand in the calculation. So please just note the difference between the two methods over there. Okay, and in addition to that, let me take that one step further, sorry, just because I really can't help myself and I have to explain it completely. If you were calculating the net present cost, guys, so apart from not including that in your calculation, all of your other cash flows will be exactly the same. You would then use the after-tax cost of debt as your discount rate, so the rate on similar loans or the market-related rate, and you would then solve for the net present value, or in other words, the net present cost, which is more accurate terminology over there. And that would then give you, yeah, the net present cost, obviously. All right, so that's just the difference between the two methods over there. All right, but that deals with option 1. We now need to calculate the internal rate of return for option 2. The non-redeemable preference shares. Okay, so if these are non-redeemable preference shares, it means they are going to be preference shares in perpetuity or forever, because they are never going to be redeemed. And if we want to calculate the internal rate of return or the cost of the preference share, we need the dividend, and we take that dividend and we divide by the present value. So they are going to issue 50,000 non-redeemable preference shares with a nominal value of 100 Rand each. And the preference shares carry a cumulative dividend that is payable annually at 8% of the nominal value. All right, so in order to calculate the dividend, it's 50,000 preference shares of 100 Rand each. That gives us the Rand value of the preference shares, and we then need to multiply that by 8% to get the dividend. And the present value follows exactly the same logic as the present value of the loan. It's the initial amount that they are going to receive when they issue the preference shares. So they are going to issue 50,000 preference shares at 100 Rand each. So the present value is 5 million Rand. So that's going to give us a cost or an internal rate of return of 8%. So for the loan, the internal rate of return is 7.1%, and for the non-redeemable preference shares, it is 8%. So make sure that you answer the required, what is the most cost-effective form of finance? It is going to be the loan. Which was option 1.